Hey, welcome back. So last video I was talking about going into the battle plans of like if we are to encounter a market crash, what are my plans? First one is I talked about shorting for stocks. This part I will be talking about two more options that you can kind of explore. And honestly, like I want you guys to pick out what you guys can use out of this thing. You don't have to use like, this has to be contained specifically in Battle Plan 1 and so forth. You can pick stuff from Battle Plan 1 and move it in Battle Plan 2 and 3 and so forth, whatever. It's all interchangeable. I'm not telling you exactly how to do anything. You guys can pick whatever you understand and do whatever works for you. But one of the most important strategies in this that you cannot avoid, it is part of the secret battle plan, which is to hit that subscribe button, hit that like button, and leave a comment. That bonus part of the battle plans, you can take anything you want, but I think that is the most important. The bonus is very important. So reminder to subscribe. But as we move on, battle plan 2 options. And there are a variety of ways you can do this. You can craft it very intricately. It's very complicated. Options are a very difficult vehicle to understand because you have to understand the Greeks. You have to have a solid understanding of the Greeks, timing and so forth, and pricing and all that sort of stuff. Is very difficult. And the first one, which is why I put the first one as scratch card / lottery tickets. Easiest way to think about it, especially if you don't know options, is call up, put down. There, simple. So if I think the price is going to die, then I'm going to take a put option. But let's say I don't have a bunch of money, right? Well, I could take a put option that's further out into the price. So like instead of taking the $40 puts, I'm going to take the $30 puts because the price difference is between 15 cents and $60. So that's the price of the 14. So I'll take the 30s because they're 15 cents or $15, multiply by 100, whatever. So again, that is one option. I will move on to I know the risk I will move on to in the risk profile, but the next one is strangles. Now, there are different ways to do strangles. There are some that are really at the money. Some, I don't really know if anybody doing it in the money, but there are some that are at the money and some that are super out of the money. And the at the money one is basically like you buy the 56 calls and then you sell the 55. You buy the 56 calls and you buy the 55 puts. So you're basically buying the options on both sides. Well, if you're hedged, how do you make money? Simple. If the price move is that extreme enough, let's say it goes down to $30, the option that you have that you had on the call side is going to be depressed to zero at some point, whereas the put option will actually go in the money and start accelerating even faster because of delta. Again, you have to understand Greeks, but the delta acceleration will be a lot higher, and the delta acceleration to the point where on the other side of the option is just going to fizzle out to nothing. So your put side will actually make your position profitable because it can keep going. It has no ceiling cap. Losing side has hit its floor. Other side, no ceiling cap. So the last one is covered calls. And this is having to do with if you have stock in it already. And the great thing about covered calls is that even if it doesn't move, or if it doesn't move in time or like the time fashion that you think it's going to move, you'll still get some money due to theta burn because you're selling a call on top of your position. And because it's covered, the benefits of it is that if it shoots up into infinity, even though you are short a options contract, the delta can only go as high as 1 and a 1 for 1. But for the most part, like if it goes into the money, the call that you sold, if it goes in the money and it exercises, you have the shares to cover it. No harm, no foul. You get to collect the premium plus whatever the price difference is of whatever the strike you pick. All right, moving into my favorite section, the risks. Now, the risk with Battle Plan 2, the option side, is that lottery tickets can become expensive. And, if you were to track a lot of these things, sometimes the lottery tickets don't pan out. And the hit rate is typically very low for some of these things. And obviously, if you guys probably should be tracking, but if you track your the rate of which you win your lottery tickets or scratch cards plays, and they're actually net negative, it can become quite addicting because it's a thrill of gambling and stuff like that. But honestly, if you're not making money, then I don't see what the point is of you taking lottery ticket option trades. But moving on to that. Strangles. Strangles have a very key weakness, and that is actually a couple key weaknesses. First one is basically if you take two out of the money options and it's way too far out, even if you're right for one single direction, if it doesn't move fast enough and strong enough, you might get your options fizzled out because time is against you in this scenario on both sides. And on top of that, because time is also against you, the longer it doesn't happen, like let's say it doesn't even happen at all, you could basically burn the entire strangle there because it just didn't happen. It didn't happen far enough, or you didn't pick too far out of the money options. It's just a risk that you incur. Next one, for the covered calls, you might incur in opportunity cost if you're wrong. And what I mean by that is, like, let's say you have a stock at $10 and you basically sold the $10 call option against that because you're like, oh, I don't know if this is going to go right, go wrong, whatever. And it's, it slips below a little bit. You're a little unsure, whatever your reasons. You can make up whatever your reasons you want, but it slips a little bit low. You get your covered call, and next week they just announced that groundbreaking new deal with the government, tons of funding and stuff like that, whatever reasons, catalyst that pops up, and this thing goes from $10 to $20. Well, you just lost out on $10 as upside because minus the premium of the option because you just got scared and you put it down there. It's not always the case, but it's typically a scenario that could happen. One of the last things I also wanted to side note was that your options can be lapsed, and this is, according to IB, they said it's like a 1% chance, but I think it's more like a 0.01% chance, which it's you're not batting one for a million, you're batting one in a trillion scenario where let's say as an option, like let's say you got into that $10 option, right? And you sold you bought that stock for $10 and then you sold the call at, like, let's say 30 cents. So $30. So you have $30 in coverage on that thing. And I'm taking the other side. So I bought it from you. I give you the $30 and I say, after a while, it jumps up to like, 15, 12, 15, whatever. Let's say 15, whatever, right? And I, for some reason, say that, you know what? I don't want it. I don't care. I'm going to throw the option back in, or I'm just going to choose to let it expire. I don't want to exercise this option, whatever reason, right? Typically, it's the other side not wanting to exercise the option, but that is a thing that can happen. It's called option lapsing, and it's usually when I just say nothing. So you get to keep that $30 and you get to keep your stock. It's kind of a very like black swan scenario for that to happen. It doesn't happen very often, but what does often happen is that let's say, for example, you had that $10 thing there, right? And let's say at expiry, on the expiry date, market closes at 4. The option market closes definitely at 4, but the stock market doesn't close until 8. So even though the underlying says it closed at 9.94 or whatever, well, in the after hours, it went up to 10 and beyond, or whatever, right? And let's say whatever your broker, again, you have to check your broker's actual closing times for this. Everybody's different. Some of them close at 4, some of them close at 4:30, some close at 5. But whatever that price is at closing, let's say it goes above $10, and I say I want that options contract, or I want to exercise my options. You still have to give it to me, and you can't get out of it. You can't weasel your way out of it. You can't argue, say like, well, it closed at 9.94. How is it possible that you still are able to exercise this option? Blah blah blah. Again, these are little nuances that people neglect to look at for options when they get into it. I even neglected to look at it. I just stumbled across it by accident when I was asking a question. So these are things that you have to discover either doing it in a safe environment or asking someone like a qualified financial advisor, a qualified professional that has all the certifications in the world. Not that they just say that they work for it. Make sure, like, do your due diligence on that too. But these are little nuances that you have to learn going forward, especially if you are to build such an intricate plan, and especially a complex one if you are involving options with it. All right, so then we move on to battle plan 3, and that is to almost do nothing. And articles that there were articles that are talking about some of the best performing portfolios were from investors who are dead or literally forgot that they had an account. Now, I'm a little impartial to the situation, and hopefully you're the latter. But if I don't understand a situation, I'm not really I'm very hesitant to put my money forward, even though I'm a very active trader. I'm very hesitant to throw money out just like that when I don't have a stronger assurance of that play actually panning out, or if this is like the actual drop or not drop or whatever, right? So again, like everybody's different. You guys can formulate and pivot how you want to, but the last part of this is also to dollar cost average if you are in the latter. And a lot of people do this, or a lot of people like Graham Stephan and all that sort of stuff advocate dollar cost averaging. And like I said before, like I don't want to say a precision trader. I'm more of a stubborn trader when it comes to dollar cost averaging. I don't like to dollar cost average into anything. I like to dollar cost average, well, in a worse sense, where I lean more into the stuff that's actually working. And I might be late to the game for the most part, but like a lot of the institutions, they catch on very slowly. It's just look at Bitcoin, for example, right? Like how they didn't adopt Bitcoin. Then when it started making a lot of waves, they're like, oh my God, there's a lot of money we could actually make in this. They started to go harder and harder into it. Like, started accepting crypto, started doing transactions and stuff like that, so forth. I'm more like that because I come from that world. So I will be probably one of the second to last to know that this is going to be a huge thing because I'm not really fanaticized by it. But I will go a lot harder with the cash that I put in there personally, because I know that this is going to be bigger than what it actually is. So again, that's something of a confidence thing and something of a luck thing, I would say, more than anything else. There are some things that are luck, but obviously there are some little nuances that I might find in their filings and their legal obligations or contractual obligations that they have to fulfill. All right, so the risk of Battle Plan 3 of do nothing. And that first one is that your company that you pick might not survive. And Blockbuster is a great example of this. Back in the day when people had to go to the store to rent a video, and Netflix was also there to mail you the video, and you just mail back the DVD and stuff like that. But back in that day, Blockbuster had the chance to buy Netflix. They saw the writing on the wall, they saw the digital age, and they said no, because they did it in favor of setting up their own home streaming services through the internet, through a subscription or whatever. I can't remember the full nuances of that. You guys can look that up on your own time. But for the most part, it didn't pan out. And after some bad luck, they basically just faded into obscurity. It wasn't for lack of trying. But that's just some material risk that you should be aware of. But on to the second point, which is not having any money to DCA. Now, I know that not everybody's broke. I just know a majority of the people who hate me are broke. But there's nothing I can really do about it, because a lot of these people who don't have any money to DCA are also people who have been laid off in the last year and so. And I understand being laid off. Like, I've been laid off in the most backhanded ways before too, so I understand. And there's not a lot you can do about this scenario. If I was to be the tough dad right now, I would say just suck it up and go find another job. Like, nothing's stopping you from looking for another job, any shape, way, or form. If you really want it that badly, you will work towards it. But if you don't have any money and you don't feel like you really want to do anything, I mean, that is just something that you are happy with, and that's you. You do you. But I will say on this last point, which is you might miss out on opportunity costs, sort of. There's a double-edged sword to this. So let's say if you didn't have any money to DCA into this thing, and the stock tanks or it becomes one of those flops in scenario one, you might be glad you didn't DCA into it, because that would have been a larger loss that would have hurt a lot more. Again, know what you're buying. And on the other hand, I know the opportunity costs of missing out on a trade. I lament that like crazy sometimes. And the important thing is to obviously have a diverse portfolio and to have a plan, know what you're buying, and stick to it. Like, this is a business. It's not simple. It's not that easy. Like, I'm very late to things. especially for opportunity costs. I might be super early to things, but I'm also really late to things. And I, like my institutional colleagues and background and stuff like that, we're really late to things. We're late to adopt things, but we're the ones that will come in harder with more cash and everything just to make up for that lost time that we had. Again, I know that there are some channels out there and some people out there that just all into one stock. I'm saying that's absolutely stupid, because you live and die by that stock. And if you pick poorly, then your channel dies with it, your portfolio dies with it, your life savings dies with that too. And I'm not about that life. I want to be as generalist as possible, and I want to be as diverse as possible. I say this while having 40% of one of my accounts in one stock right now too. So my final thoughts and comments are that you might have misjudged everything. I might have misjudged everything. Stuff happens, and I would encourage you to develop your own plan of action and assess the risk. And don't just look at the stuff that, that pleases you, that makes you feel good inside and stuff like that. You have to look at everything. That includes the material risks, or, their filings will have some section that says risks aboard, like, it might be a lawsuit, it might be a patent thing, it might be, counterparty risk, that sort of thing, right? Those things you should be cognizant of, because they are literally telling you this is what the issues could be. And, on top of that, I want people to have realistic expectations, because there are a lot of people who have like this whole notion, like the stupidest thing I've read, which I knew was going to happen, was, and full disclosure, I do have shares of Hood, but Hood, day one, I see nothing on StockTwits but short this stock, this thing is garbage, they F the people, so we're going to F their stock and that sort of stuff. Can we short Robinhood? Yeah, it's all funny and stuff like that, and the social culture is all about like dunking on people, but I'll tell you why they're wrong. Because they don't understand shit about market mechanics, and that is a huge nuance. Because one, how are you going to short it day one? And two, its IPO price was 38. Yes, it did go down on the first day to 33. Yeah, but that wasn't because you were shorting it. You were incapable of shorting it. So if you were to like, let's say if shorts were available the following day, for some miraculous reason or whatever, let's say shorts are available the next day and they were to jump in on that. Well, the current price is 45 right now, or 44, 43. I can't remember. So you'd still be losing on that thing, and then so forth. But whatever. It's funny how the shoe went on the other foot, and now the people are shorting things now, and shorting's not so bad. Funny how that happens, right? But essentially, what I'm saying is, don't pigeonhole yourself into thinking that this is the crash, this is the end of it, this is the start of it, this is the stock that it's going to be. Don't all in. Be adaptive, be diverse, adaptive, and be willing to accept when you're wrong and to move quickly to right that wrong. And as well as, like, when you're doing that, I want you to know what you're holding and why at all times. And obviously read the risk disclosures and stuff like that. So if something about your original analysis and the reason why you got into that stock changes, you might have to change with it. I mean, that's what Lynch has said for years. And Peter Lynch was one of the greatest investors of all time, before Buffett and everything. But if it's anything else and you didn't take away anything else in this video, the last thing I would say that you should probably take away is that just remember, just because you're a day trader doesn't mean you have to trade every single day. See ya.